Welcome to another Rogers Capital monthly market commentary where we attempt to be the antidote to water cooler wisdom. Well, I've just had this past month in February my 25th anniversary in this business. It started in February of 1998. And it's interesting. 25 years ago, people used to say, you don't look old enough to be telling people what to do with their money. And it's funny, I don't hear that so much anymore. I wonder why. Well, good to see you again. This month, we after starting the year pretty well, we in February gave about half of it back. So down 3% last month, leaving us still positive for the year, but again, giving about half of it back. The roller coaster continues. And that really, I think, because we just don't have much to get terribly excited about. It's kind of the same story. Inflation, at what pace, whether and at what pace it's coming back to normal. What's the Fed going to have to do to hasten that return to normal? And of course, we've got geopolitical stuff from time to time. Just a lot of things going on. We end up with more of the same, this roller coaster ride that really we've been on since, last February. So now as earnings season winds down, the consensus estimate for earnings growth for Q4 came in at negative 4.9% year over year. That's the first decline that we've seen since the third quarter of 2020, which you'll recognize as the pandemic quarter, the results, the earnings from that pandemic plunge. And really, kind of have to expect further, albeit modest, downside from here as the Fed's rate increases take effect, as this economy slows. Consensus S&P earnings per share estimate for 2023, so the end of this year, is $223 per share. That's a modest 3.2% drop year over year for this past year. So the expectation is that we kind of muddle through with this economy in the near term with a late year rebound as inflation hopefully, likely, falls further. One interesting thing to note, average earnings response, the market's response to the earnings we've just reported in this quarter, kind of indicates that maybe most of the bad news is priced in. Signals some stability, maybe not optimism, but at least some stability for a downside. Let's talk soft and hard landings for a minute. That's something you've no doubt heard a little bit in the news. I'm hearing it more and more. Is this going to be a soft landing? Is it going to be a hard landing? Not the best example, really. It comes from, landing a plane. We've all been on planes. You'd really love, right, that soft landing where the pilot brings it in and just kisses the runway. Certainly in comparison to the pilot coming in and bouncing the thing, off the runway in a hard landing. But again, not the best analogy necessarily. Economic activity does not stop. The plane eventually comes to a stop. That's not the way economic growth works. It may slow down, may even go negative into contraction, but it never stops. Really, it settles into a groove, what we're hoping for, right? It settles into a groove with consistent growth and productivity. So really, a better analogy would be running. The Fed's looking to get this economy hitting its stride with consistent, sustainable, predictable growth, a growth path, and prices. And that's not easy given the transition back to normal post pandemic from a couple of years ago, which was such a crazy event. Now, if the economy breaks the back of inflation without a deep, prolonged recession, then we should see lower volatility, improved conditions for investors later this year. The data is mixed, and you'd kind of expect that. First of all, with seasonal adjustments that are necessary. So many things are seasonal. Agriculture, for example, is seasonal. There's time of year you put it in the ground and the time of year you harvest. Energy tends to be seasonal based on the heating oil, obviously in the winter, or travel in the summers. You've all noticed what happens to gas prices when Memorial Day hits, or 4th of July, or whatever. Holiday shopping is obviously seasonal, and so we have to take those and factor those seasonal adjustments in. But when you compound that with, of course, now COVID repercussions from a couple of years ago, supply chain repercussions, the government shutdowns that we had seen, fiscal monetary policy that has just flooded the economy with cash, with money, it makes it tougher to normalize those patterns of economic activity. The best rule of thumb is just to wait for at least a few months in a row of unusual strength or weakness before we draw any conclusions. Now, the bottom line is, at least right now, the yield curve, this deeply inverted, we've talked about the yield curve, previous videos, is a negative sign for at least near-term future economic growth. Now, we obviously hope that there is no recession on the way. And if there is, we hope for the softer, side of that. It's pretty obvious the stock market's not terribly worried, but Q1 economic data isn't as clear as some might have you believe. Really what we're waiting for is something to materially change. So that's it for this month. Happy spring to you. Hope you have a great March and a great spring break, and we'll talk to you next time.